Factor models have changed how we understand risk and return in investing. But how do they really work? In just 2 minutes, I'll break them down for you. In finance, factor models are used to explain and predict asset returns by identifying key variables, called factors, that drive price movements. These models help investors understand why assets perform the way they do and how to build better portfolios. There are two main types: single-factor models and multi-factor models. A single-factor model assumes that one dominant source of risk explains most of the variation in returns. The most famous example is the Capital Asset Pricing Model, or CAPM, which uses the market factor, the overall performance of the market, as the sole driver. According to CAPM, an asset's return depends on its beta, or sensitivity to market movements. But asset returns are influenced by more than just the market. That's where multi-factor models come in. These models include multiple factors that can influence returns. For example, value refers to investing in stocks that appear cheap relative to their fundamentals. Size is the idea that smaller companies, or small-cap stocks, often outperform larger ones. Momentum suggests that stocks which have performed well recently are likely to continue rising in the short term. And finally, quality and liquidity measure a company's financial strength and how easily its stock can be traded. One widely used example is the Fama-French three-factor model, which adds value and size to the market factor. Factor models are not just theoretical, they are tools for action. Investors use them to build portfolios with better risk-return profiles. For example, a factor-based ETF might tilt its holdings toward high momentum and low volatility stocks to seek enhanced performance. They're also used to analyze fund performance. By breaking down a mutual fund's returns into factor exposures, investors can see whether a manager is adding true skill or just loading up on known risk factors. Let's take a quick example. If a fund consistently outperforms the market, but its performance can be explained by high exposure to small cap and value stocks, the manager might not be outperforming due to unique insight, but just riding those factors. In short, factor models offer a systematic way to understand what's driving returns and help investors design smarter, more efficient portfolios. Thanks for watching another episode of Finance in 2 minutes. If you found this breakdown helpful, hit that subscribe button and keep learning with us. And do not forget to grab your free summary cheat sheet using the link in the description. See you in the next video!